So welcome to you all. Thank you very much for tuning into this session. So my name is Nora Pankratz, and I'm a postdoctoral researcher at the UCLA Luskin Center for Innovation. And I'm particularly excited about this session. So we're going to discuss how financial markets are potentially responding to adverse climate impacts. Before we get into the talk, let me quickly mention that we're really grateful to our collaborators. Without them, this event would not have been possible, so thank you on this note. Apart from that, before we jump into the talks, let me quickly run you through the tool here. In case this is the first session that you're logging into, then this might be helpful. So what you can see in the conference tool is a couple of different widgets that you can use to, for example, check out the abstracts of the talks that are held. So if you click on this little icon with the paper, but most importantly, there's an icon that's labeled Q&A. And I hope you make use of that because that enables you to send questions to us that we will then answer in once the presentations are through. And lastly, again, just in case this is the first session you're logging on to, there's a little question mark icon as well. So in case you should need technical help, then please reach out and we'll do our best to assist you. All right, but with that, to our presenters. So we have three really great speakers here today, three exciting talks to come. So first of all, Michael Barnett from Arizona State University. He's an assistant professor of finance, and he's going to talk about the pricing of climate impacts in municipal bonds. Second, we have Ivanov from the Federal Reserve Board. He's a senior economist at the Division of Research and Statistics. And lastly, we have Jawad Addoum from Cornell University talking about temperatures and the pricing effects in the stock market. All right, with that, I think we should also get started with the first talks, maybe just as a quick outline. Again, I bet you're already familiar with this format now if this is not the first talk you listen to. So we'll go through the presentations, and then right after the presentation, there's space for Q&A. So before we jump into the talk, let me quickly also stress that questions are really, really welcome. So I see we have a really diverse audience from the industry, from policy, and from academia. Whatever your background is, please feel free to ask your questions. And if we don't manage to get through all of them right after the talks, we'll still make sure to follow up with them. Okay, but with that, very much looking forward, and over to you, Michael.
Great, thank you so much. Hopefully you guys can hear me now. So first, I just want to say thanks so much to the organizers for putting our paper on the program and for putting together this sort of really neat conference that has this sort of broad, diverse group of topics around climate change. I'm excited to hear what's going on. And so today I'll be presenting joint work with my co-author Konstantin Yannelis at the University of Chicago. And we're going to be talking about whether projected climate damages impact sovereign bond yields. So I want to start out by showing this map. And what this map shows is projected climate damages, either for 2037 in the top map or for the long run, which is sort of over a couple hundred years in the future. Projected climate damages by country coming from a study by Compass et al. Now, I think there's two important features that I want to highlight here. One is you can see that there's clearly sort of a very sort of stark heterogeneity across countries in terms of the projected impact. So if you look at the top map, you'll see that these damages range anywhere from actually positive benefits from climate change in some of the northern and very southern regions, ranging to something like -5% reduction in own country GDP as a result of climate change. And then the second feature is when you compare these two maps looking at the long run, again, you see the same heterogeneity in many of the same countries experiencing large damages. However, the magnitudes are clearly increasing over the long horizon. And so the size of these impacts have now gone from about -0.5% decrease in GDP to something along the lines of almost -20% GDP. Now, given that there are these expectations from scientific studies about the impact of climate change, what we think is particularly interesting is what you can see in this next plot. So this is a map that shows sovereign bond yields across countries, and these are the average sovereign bond yields across maturities by country. And you'll see here that, again, we have this stark heterogeneity, ranging anywhere from sovereign bond yields that are slightly negative to somewhere up on the order of almost 9 basis points per year. What's important and what we thought is interesting is that there appears to be some correlation between the magnitude or the risk compensation that these bond yields represent and the expected damages for climate change. Now, this is clearly just like a correlation, maybe some suggestive evidence, but it hints at what we're interested in particular in our study. So to be a little more formal, the question that we're interested in studying is, do projected climate damages impact sovereign bond yields? Now, we find this to be a very critical question, both for academics and policymakers. And there are a couple of reasons for that. One is that climate change mitigation decisions are going to be largely made at the national level. So as researchers, we're understanding in the economic implications, and sovereign bonds reflect sort of national outcomes. They reflect, in terms of the bond yields, the risk compensation and the price of capital that these countries are going to be exposed to. And we think that's an important question on its own. But what we think is also relevant and interesting about this question is that the borrowing costs that are seen today, as seen through the bond yields for these sovereign bonds, may then serve as a disciplining device for policymakers, governments, elected officials who may be thinking on a shorter term sort of closed time scale that they otherwise sort of don't take into account climate change. So as we study this question, and if we see some impact, it reflects the sort of the necessity for policymakers to then start taking that into account in their own short-term decision-making processes. So we're going to do an empirical analysis, and the strategy that we have is to use scientific projections of climate damages at country level, a country time level. Now, what's important about this isn't that these are perfectly accurate estimates, it's that they give us the best measure of expectations of future climate damages. And that's what asset prices, including these bond yields, are going to reflect, is expectations about future outcomes. Okay? And the second part is that we're going to compare the spread in bond yields between long and short-term bonds to help us then identify this key feature of whether or not climate damages, which have long-term risks, are impacting bonds at different maturities in different ways, and then helping us understand what that impact might be. Now, the key results that we find are that projected damages are going to have small and almost essentially no effect on short-term bond yields and bond yield spreads, but we're going to observe large effects on the long-term bond yields and bond spreads. And these effects of projected damages are going to be monotonically increasing in maturity. And so as these impacts go out for longer horizons, the exposure get larger, and we see exactly what you would expect, that these impacts for the bond yields are larger. Now, this has implications broadly, sort of in a broadly speaking context, for asset prices and macroeconomics. And so I'll talk a little bit about what this might imply in those settings. Sorry, change that. Okay. So there's a pretty extensive related literature. I'm clearly not going to have time to talk about all of these. I just want to highlight the fact that there's a great sort of extended and long-lived literature in terms of climate economics, a lot of wonderful work being done empirically and theoretically, thinking largely about the different types of climate damages that exist, how to measure those, and what economic implications that might have. And more recently, there's been a lot of really great work done in the area of climate finance. And this looks at implications in financial markets in terms of housing prices, stock returns, and even using sort of theoretical asset pricing tools to analyze these types of risk and how to quantify those in social welfare prices. The recent work that's been done for climate bonds is very new. It's interesting. It's focused largely on municipal bonds and corporate bonds using different types of climate damages. And so where our paper is going to make an important contribution is extending this analysis to thinking about sovereign bonds, again, sort of that national level impact, and looking at these climate damage predictions on sort of a larger scale rather than sort of individual types of damages. So let me highlight quickly the empirical strategy that we're going to use, and then I'll talk about the data and show you some results. So the main empirical challenge that we face in our analysis, and this is true in sort of all empirical estimates of climate impacts, is that the damages from climate change may in fact be correlated with other factors that are impacting yields. You could think about them moving hand in hand perhaps with GDP growth or some of these other features. And so what we want to do is try and isolate this effect and identify it as cleanly as we can. So what we view as a nice solution to this problem is comparing the long and short maturity sovereign bond yield spreads. And that's because the yield spreads are going to difference out the short-term country-specific factors and other sort of similar factors between long and short-term yield bonds to hopefully help us identify features that impact long-term maturity bonds differently than short-term maturity bonds. So the main regression specification that we'll use is going to be this given by this equation where we take YC is the bond yield for country C, and we'll take the difference between the T-year bond yields, so anywhere from 1 to 20 years, and we'll subtract the short-term 1-year bond yield, and we'll regress that on a constant, this D sub C variable, which is going to be our projection for climate damages for country C, controls, and what we're going to show here is going to be sort of very simple. The controls will be pretty sparse, but we've extended that and shown that this sort of persists no matter what sort of bucket of controls we throw at things. And so the coefficient of interest that we're going to be estimating is going to be beta, which is going to capture the effect of an additional projected percentage point of lower GDP growth on the yield spread. And that, just to make sure we sort of understand it, that coefficient we would expect to be negative. As climate damages get worse, the D sub C variable becomes more negative. And so as that gets more negative and there's a negative coefficient, we would expect bond yields to go up. Higher risk compensation is what that's reflecting, okay? So the identifying assumption is that projected climate damages are uncorrelated with unobservable determinants of the yield spread. And this is going to be true, and again, part of our identification is that projected climate damages only affect long-term maturity bonds rather than short-term, and that other correlated country-specific factors affect bonds identically. So when we take this difference, we're able to observe and hopefully isolate the climate damage effect that we're looking for. Now, the data sources, I'll be quick about this. Data on sovereign bonds are going to come from Bloomberg's data set. And we're going to be looking at cross-sectional estimates for now. Again, we've extended this to panel regressions, and there's some interesting results, but I'll just focus on this subset given the time I have. And again, these are going to be the available maturities for the most recently issued bonds for each country in our sample, and we'll have about 120 countries. And so additional macroeconomic data we'll get from World Bank, Fred, DataStream. And then the other key variable is going to be climate damage projections. Now, all the estimates I'll show you here focus on this study, scientific analysis by Compass and co-authors in the recent 2018 paper, where they get estimates of climate damages based on results from large dimensional intertemporal computable general equilibrium model. Okay, that's just a sort of a scientific way that they use in the geosciences to discuss a model that has a very sort of large multi-system dynamical equation set, okay? Now that model is going to incorporate estimates from meta-analyses based on the IPCC's assessment report of how damages play out from climate change. And then the underlying emissions pathways are going to be based on IPCC scenarios, either the socioeconomic or concentration pathway scenarios that they use. So we're going to take those estimates for their study and use that as our main variable of interest. To sort of get at the robustness, we'll also test additional damage measures. One of those is Marshall Burke and co-authors' paper, where they do sort of their own regression estimates of damages in their own simulations. We'll get similar results there. So this is sort of robust to the type of damage projections that we use. So I'll dig right in now to some of the empirical results that we get. The first set, before we get into the bond yield spread, is just going to be regression looking at the impact of projected damages on bond yields directly by the projection horizon. And what you'll see is that across all of these different estimates, first, evidence that there's a strong statistically significant negative impact, meaning that as climate damages become larger, bond yields are going to be increasing. And that's true across the different horizons of climate damage projections that we use. And that's true whether we use levels or logs, and gives us sort of our first set of preliminary evidence that there's going to be, in particular, there's going to be some impact of climate damage projections on the bond yields. Our second set of results then focus on looking at differences across maturities. Again, trying to identify whether or not there's going to be evidence of increasing impacts for longer term exposure to climate damages. And so here we have a bar chart where we show the effect of projected GDP loss on yields by maturity, going from the less than 1 year bond yield maturities up to 1 to 5 year, then 10 years, and then 20 years. And clearly we have this nice monotonic relationship. Each of the estimates is negative and becoming increasingly more negative, suggesting that this long run risk component that we would expect in climate change damages is amplifying the results. So those bonds with the longest maturity, which should then have the largest sort of exposure to climate damages, are the ones where we estimate the largest climate impacts. And to sort of look at the numbers, again, these estimates are those same regression results that we just showed in that previous bar chart, but showing sort of the magnitude and significance. Again, you see that at the 1 year or 1 year and less than maturities, holding fixed the projection horizon of GDP damage losses, we see that the effects are negative, but statistically insignificant. And as we move to the 10-year, greater than 10-year, and 20-year estimates, we see these negative, statistically significant impacts where we get a decrease in GDP, 1% decrease in GDP for a country leads to something on the order of a 2 basis points change in the bond yield. So now I'll show the final set of estimates that we have, and this focuses on our sort of main regression equation and main identification structure where we look at the bond yields and the spread in these different bond yields. Here we're regressing either the 5-year minus 1 year bond yield or the 10 minus 1 or 20 minus 1 bond yield on these same damages and control specification that we've had. And again, all of these are including things like country level controls and different maturity fixed effects. And what we're going to find is similar to what we found with the yields directly, is that for the short-term yield difference, this 5 minus 1, here we have a positive but statistically insignificant impact. But as we look at the 10 minus 1 and 20 minus 1 bond yield spreads, the impacts become negative and statistically significant and are increasing monotonically as we look at a longer term maturity. Again, up to almost 1.5 basis points at the 20 minus 1 year bond spread. So what do these implications mean? We think we have some fairly robust and sort of important evidence that these projected climate impacts are impacting bond yield spreads. And so how do we interpret these results? Well, we note that increased sovereign bond yields imply a higher cost of capital for countries with increased perceived climate risk. And that's because the bond yield is reflecting the cost of capital through the required risk compensation that investors need to receive in order to purchase a bond. And so what's driving those results? What's driving those higher costs of capital? Well, it's the greater likelihood of default due to expectations of increased significant government expenditures or reduced government revenues coming from these damages. And so the channels that this might be playing through are going to be the repairs or the expected repairs from climate damages. Think about sort of the cleanup and efforts that have to happen after large wildfires or increased intensity hurricanes from climate change. Also, the need to pay for infrastructure to adapt to climate changes. Places like Miami, where they're having to build higher seawalls, or different coastal towns where property has to be protected against increased high tide, increased flooding, et cetera. These are some of the infrastructure channels that might be expected in the future. And then again, reduced economic growth and productivity because of the interruptions that come from climate damages. And these could range from things like migration to change in the production technology that have to take place. And so what are then the expected broader economic implications? Well, again, we're focusing here on sovereign bond yields, but we think that there's going to be a broader impact, that financial markets through bond yields are observing this. And so we would expect that equity prices might also be impacted, and particularly for firms with the greatest exposure to damages, adaptation costs, and even climate policies that might take place. In other work, I've shown that's likely to be the case, that equity prices are seeing this as well. And so there's evidence that not just bond markets, but then sort of financial markets at large might be impacted, but also firms in terms of their production technologies are likely to have to implement or are going to have imposed upon them significant changes in their production based on climate risk exposure. And so our evidence suggests that these are channels and things that we should start exploring, and that evidence showing up in the bond yield spread might suggest that there are other avenues that we need to consider and broader implications for both the financial markets and the macroeconomy. So I'll conclude here. We find that projected climate damages impact current sovereign bond yields, and we find that countries that are projected to suffer more economic damage from the effects of climate change see higher borrowing costs today. We find that this impact is monotonically increasing in the length of bond maturity, consistent with the expectation that the longer term damages of climate change should show up in assets with longer maturities. And we think that these are particularly relevant because sovereign bonds are important as policies determined about how to deal with climate change will be taken at the national level. And so looking at these national level sovereign bonds is critical. And that the increased borrowing costs reflected in this change in bond yields that are showing up today can then be an important disciplining device for politicians, governments, and policymakers who might otherwise have short-term incentives, and so then can incorporate those short-term high capital cost incentives into decisions that benefit long-term outcomes. So thank you very much, and I look forward to your questions.
Great. Thank you so much, Michael. First of all, let me say I created a little bit of chaos in the introduction. So obviously this was not about municipal bonds, but about sovereign bonds. Presentation made that very clear. Okay, I think the Q&A is still really quiet. So let me once again say your questions would be very welcome. I'm sure a lot of you had thoughts, comments, maybe points that would be good to clarify. So I'd say we just give it a little bit of space and time right now to see if something pops up. Often that is all it takes. Okay, if not, maybe I'll start with a question, but again, with the encouragement to just post whatever's on your mind into the Q&A box. Michael, I was wondering while you were talking about it, so on the potential channels that might play a role here. So you said that both adaptation and the damages in itself could drive this increase in spreads. And I was really curious if you thought about ways to disentangle the two, just because in a sense, adaptation might be the one mitigating one of the, so to say, the competing channel there. So did you think about whether you have countries that are similarly affected by climate, but have like a very different profile in terms of their governance or potentially financial capacity to adapt? Just curious whether that's part of your plans.
Yeah, so that's a good question. I think, there's been some nice work looking at municipal bonds that have sort of looked at this directly, right? Sea level rise is going to have implications about adaptation. There's sort of, in some sense, one way we can try and identify this is by thinking about different countries and their different exposures to damages. So those sort of coastal countries might have, for example, just with sea level rise, might have more need to, have capital expenditures in terms of adaptation. So we're sort of working through that process now, but I think given the level of sort of country heterogeneity that we have, we think that there's a potential for using some of that to sort of isolate specific regions or types of countries, again, both geographically and by wealth, as you mentioned, to determine which are the types of channels that might matter. So another example is that those sort of more wealthy regions may be in better place to deal with adaptation, already having some of those things in place, and so they may be more subject to, for example, the types of damages that come even regardless of adaptation costs that come in the future. So I think that's something that's on our list of potential things to identify, and one way we think we might deal with that is sort of the different heterogeneities that we have in terms of wealth by countries or geography, for example.
Yeah, great. I think that would be very interesting to look into that. But again, also with early projects, that's always something that unfolds naturally. Okay, great. But by now we have lots of really good questions in. So maybe we can start off with Glenn Rudebush is asking, have you thought about how this changes around, or his question is, have you thought about event studies, say, after the Paris Agreement? So I guess the question generally, how does this change with changing awareness?
Yeah, so this is a really interesting question. So some of the other work I've done, I have focused on this particular, and it seems to be relevant. So in some sense, the most pronounced results are showing up when I look at equity markets, for example, sort of post, let's say, Kyoto Protocol, and so when we started having some of these large agreements. Now, in the analysis that we're doing here, again, these are sort of just cross-sectional estimates that I've shown so far, but we've started building out the panel precisely for this reason. And what we have seen in some of the early estimates that we're getting is that over time, there seems to be variation and the effects tend to be amplified. We do see that there's sort of some time variation that might correspond with either different types of policy announcements or particularly with like business cycles, for example. So during sort of the Great Recession, it looks like estimates tend to sort of squeeze down in terms of the magnitude, which we think makes sense. But yeah, that's we want to start extending this to panel estimates, and that's sort of on our list, and we've looked at it. And I think precisely for these reasons, we think there's going to be some impacts in time variation that show up, and we're hoping to tie those to these types of events like the Paris Agreement. So.
Perfect. Okay, the next one is a question by Francis Moore from UC Davis, and the question is, can you talk about the magnitude of the effect you estimate compared to the estimated effect of climate change? The increase in longer-term yields seems large compared to the estimated effects of GDP from the Compass study.
Okay, yeah, so this is a really good question. What I don't have and what I wish I had is sort of how does this compare to other features that might play out? So I'll talk a little bit about the bond yields, just looking across all yields. And so I don't have this number for the longer term yields, which is sort of what's being asked. I can look at that. But sort of the average bond yield that we're seeing is somewhere on the order of like 5 basis points. And again, these estimates are based on like a 1% decrease in GDP, which is actually sort of fairly large. That's a pretty decent chunk of GDP that would come off. And so sort of the average damage size, looking at the 2037 projections, is something like half of that. It's more like a 0.5% increase, and likely skewed because there's going to be some countries that will have very large impacts, and that's sort of skewing that out, is my guess. So the expectation is that these shouldn't be particularly large, though as you start to look at the longer term yields and the yield spreads differencing out some of these features, that these could be large, given that you have to think about what are the very long-term damages causing those. So again, I don't have a specific number to give you, and that's something I can work on. We'll have in the paper, obviously, but the expectation is, at this point, I wouldn't expect this to be sort of economically massive compared to potentially other features. Though, as you start to think about long terms, we have to determine what's sort of driving 20-year bond returns, and I think that's a relevant question. So my sense is that these aren't huge, but then again, we can sort of compare that and see how those compare to other sort of factors that matter.
Excellent. Thanks again, Michael. And with that, so we have a couple of questions left, but I think I can promise that Michael will get back to you through this Q&A function here. So with that, let's move to the next talk. And that is Ivanov, again, senior economist at the Federal Reserve Board. Ivan, the virtual floor is yours.
Thank you very much, Nora. It's very nice to be here. We're very much looking forward to the feedback, to all the great feedback that we're going to get. So first of all, this is joint work with Marco Machiavelli and João Santos. And we're going to be looking at bank lending networks and the propagation of natural disasters. Okay, before I go any further, I want to say that these views are our own and they're not the views of the Federal Reserve. Okay, so what motivated us to work on the study? So there is plenty of work showing that banks have increasingly expanded their footprint across the United States. And this is a trend that's here not only in the States, but also like around the world. Basically, many studies here have shown like very positive sides of this. So, for example, there's like small business lending growth. There is risk-sharing opportunities. There is lower fluctuations in states' economic growth, and so on and so forth. Like there's lots of studies in this end. There is not as much done, though, on the negative externalities of such growth. One thing that we're going to look at in this paper is the propagation of local shocks to distant, unrelated areas. Okay. At the same time, as banks have expanded their footprint across the United States, natural disasters have increased in frequency and severity. There is basically a number of studies that are fairly new that show that after these extreme events, there's higher demand for credit in affected regions. Like, for example, there's this Burke and Schrader paper, Portis and Strahan, Cotter et al. So there's like, I mean, these studies are just among the few new studies that have done that. What hasn't been done as much in the area is that banks that are operating in affected areas might divert resources away from unaffected areas to meet the credit demand. And as a result, this could adversely affect the supply in areas that are not affected by these events. So the overall, as a result, the overall network effect is not clear. As in this market that we're looking at, non-banks have increased their presence substantially in the last 10 to 15 years. Okay, so just to give you a brief highlight of the results, we used data from the Shared National Credit Program to study bank lending and how bank lending networks may propagate natural disasters. Our key findings here is that very similar to the microfinance, SME, and retail lending effects that have been documented in prior work is that natural disasters lead to an increase in syndicated lending in affected areas. More importantly, we find that banks meet this increase in credit demand in part by reducing credit supply to areas that are far away but are not affected by these events. These effects are more pronounced for banks that are capital constrained. In the last part of the paper, we find that unaffected banks and non-banks step in and lend to firms in these faraway unaffected areas so that the overall reduction in the supply of bank credit does not affect these firms as much. Okay, so in terms of the data, like I said, we use 3 data sources. We use data from the Shared National Credit Program to get a measure of bank lending to firms. So I'm not going to go into the details here, but these data are very, very detailed and would give you every single bank share to a firm, to a loan to a firm. So in that sense, the SNC data is unique because most other data sources that are available out there do not give detail on the lender shares. Okay, so we use measures of, we use the spatial hazards events database for the United States to measure natural disasters. So we have location, duration, and dollar damages for each disaster. In the last part of the paper, we also use data on summer deposit and rate watch to get deposit rates. Okay, so I'm going to go through this quickly in the interest of time. So the SNC data covers both private and public firms. We have a ton of very small firms, but we also have like really large firms as well. So it does cover like a really wide range of firms out there. These firms overall, in terms of the internal bank rating, are more or less safe, as banks do not make loans to really firms with really high risk. And I think the most important piece here in red, you can see that about like a fourth of all the firm years in our sample experience an disaster event, but only 4% of the firms in our sample experience a large event, right? So this is important to know, like if you're wondering where our effects are going to be identified from. So the main measure that we use in the paper about the network effects is built as follows. So we compute the weighted average exposure of each bank at time t to like events, to all events across all areas the banks lend to in year t. Then for each bank area year, we subtract the weighted average disaster damages in like county C, as well as those within a 300-mile radius from the county. And then we defined large network shocks as those that are in the top like 5 or 10% of the annual network damages distribution. Alternatively, we have an alternative definition here. We defined large network shocks as those that have the highest value for a given bank county year in the last 5 or 10 years. Okay, so this is the bank network data set. So here, like we have approximately like a fifth of the sample, or like a little bit less than that in terms of our main measure experience network shocks. And then in terms of the other measure, we have like about the same, even like slightly larger estimates. Okay, so let me go through the results. So I'm not going to spend too much time on this part, but we first studied the direct effect of these events on the demand for like loans. And so here's the first set of results. So like on the left-hand side, we have the loan amount, and on the right-hand side, we have different measures of natural disaster damages. Okay, so we have the log of damages in the first few specifications. This is the raw dollar amount in like the first two columns. Then in columns 3 and 4, we have like per capita like measures, and then we have indicator like variables in like columns 5 through 8 that are easier to read into and to read the economic effects. So what you can see from this is that natural disasters lead to 2% increase in loans, which is a fairly large effect. And these effects get even larger when you just look at extreme events, more extreme events in the right tail. Okay, so the main part of the paper, we look at networks here, and how basically lending is affected by those shocks. So this specification is defined very similarly. We have as the outcome, we have lending to by bank I in area C at time t. And then on the right-hand side, we have the own county like effect damages, and then we have network damages that this bank has experienced in areas that are far away from area C. And then we have a host of other controls, fixed effects here, like bank, county, state here, a fixed effect. So what we do here is basically we compare two counties that are in the same state at the same point in time, right? That basically are are going to be working with banks that one bank has like larger network shock versus another that has a lower network shock. Okay, so here's our main results on that end. So what you can see here is that both of our network shock measures, so as banks have larger network shocks somewhere else, they tend to lend less in the country of interest, C. And the effects are quite large. I think this is like large network shocks are associated with between 15 and 20% reduction in bank lending to area C, basically. Now, so we look at different mechanisms through which these shocks could be propagated. Basically, one major reason for why these shocks could be propagated is that the banks are not able to raise sufficient deposits, and that's exactly what we find. So I'm not showing you these results, but that's exactly what we find here. Another channel through which this could happen is the role of bank capital. So lower regulatory capital banks are likely to do this to a larger extent, and that's exactly what we find. Like the last part of this exercise basically shows that bank network shocks only affect areas that are not as important to the bank. So that's why in this set of results, you saw these effects being so large, because what you have is that banks cut lending substantially in the areas that they don't lend too much to, right? So when you weight everything, I think the overall effect is going to be smaller, but I'll get to that in a second. So I'm going to skip these slides. Strategic lending markets, I've already talked about this. I think I'm going to go to this part, which here looks at the overall effect on the firms that are affected by these indirect network shocks. And so what I'm going to do here is I'm going to be looking at this outcome Y, which would be overall bank lending to like firm I at time T, or this would be the share of non-bank lending to the same firm. And then I'm going to have like a slightly different definition of my indirect network effect, which would be the weighted effect across all the banks that this firm works with, right? This is the weighted network measure. So what we find in this set of results is, I think in the first column, we find that the overall loan amount, the average firm, is 2.7% lower as a result of these indirect network effects. And we also find that non-bank share is higher. So we find that non-banks lend more to these firms, like in turn, as a result of the indirect network effects. Now, where do these results come from? We find that they're mostly like coming from lines of credit, where non-banks don't have a very large share. So for the other types of loans that non-banks have like a large share, we find that non-banks tend to offset all the reduction in lending as a result of the indirect network shocks. Okay, now in terms of the type of non-banks that play a role in this, we basically find that like all types of non-banks that play a role in the syndicated loan market do like step in that sense. So some investors do more of it than others. CLOs, for example, in funds do more than insurance companies and PE funds. But overall, we find that all types of non-banks step in and lend to firms that are like affected by these shocks. Okay. Let me conclude real quick in the interest of time. So we find that nationwide banking organization act as propagators of natural disaster shocks in unaffected areas. we also find that non-banks tend to reduce these adverse effects. And I think other research would have to address like whether shadow banks like take this as an opportunity to expand their lending to like firms, whether these are small or large firms. And again, as natural disasters grow in like severity, it would be good to study whether loan syndicates would evolve to reduce these negative externalities. Thank you very much.
Great. Thank you, Ivan. Again, so the Q&A is going slow so far, so I just say we give it a moment. If there's something on your mind, please don't be shy. Sometimes the silence helps. Yeah, maybe as we're waiting for people to type, I think you were mentioning that already, or you're kind of going in that direction with the last point here on the slide. So how do you think about exactly, so in terms of climate change, it might have an effect on, is likely to have an effect on the frequency and severity of shocks, but also might lead to, say, often what we see studied in papers on natural disasters is only these really large shocks. It might also just lead to a greater number of shocks that are somewhere in between, maybe not quite the size of what we have in this data set here. How do you think about that? So just for translating your findings, so to say, to climate change and adaptation, do you have any thoughts on that?
Yeah, so that's a very good point. Thank you, Nora. So we definitely looked at smaller shocks as well, and we find effects that are substantially smaller than these. I think those effects, though, do not lead to like any change for the firms affected, right? So like only the large shocks are the ones that lead to a reduction in overall like loans to the firms. As the smaller shocks tend to be offset by other banks and by the non-banking sector. Now, as these events increase in severity, I think it could be the case that like we would have more non-banks and more like smaller banks stepping into the market and help offset adverse effects. But it's hard to tell at this point, right? It could be the case also that firms are affected even more and banks are even less able to like offset shocks like this.
Yeah, that makes sense. Yeah, no, thanks a lot for that answer. I think it's still quiet, but maybe it's also a good opportunity to emphasize. So I think our speakers are also virtually around after the talk. So if there are any questions you have, something to be clarified, I'm pretty sure Ivan will be glad to follow up with you. But with that, yeah, maybe just let me thank you again, and then we move on to the next talk.
Thank you.
Yeah, and the next talk will be given by Jawad Addoum. Jawad, thanks a lot for joining us. So Jawad is an assistant professor of finance at Cornell University, and he's going to talk about temperature shocks and industry earnings news.
Okay, thanks, Nora, and thanks to the organizers for putting together this event. Really exciting, and it's a real pleasure to be here to present my research. Looking forward to Q&A afterward. So the paper is titled Temperature Shocks, Industry Earnings News. I should mention before I get started, this is joint work with my co-authors who are also at Cornell University, David Ng in the finance area, and Ariel Ortiz-Bobea, who's an agricultural economist who works on sort of climate effects and temperature effects on typically agricultural outcomes. So we've sort of brought him over to the finance side for this paper. In terms of motivating the paper, first I'll say that, as the title implies, the paper is really about linking extreme temperatures to corporate profitability, and trying to think about whether or not there is a relationship between these things, and if so, trying to quantify that relationship at the industry level. And really what motivated this was, when I got interested in climate change, I read one of these IPCC reports, and a couple of facts jumped out to me in particular with respect to sort of the effect of climate change on temperature exposures. One is that, of course, sort of the well-known global warming, there is this trend of mean temperatures, rising and being projected to continue rising. But the second that I didn't know, and that now seems very intuitive and probably is very intuitive to everybody in the virtual audience here, is this idea that the second moment's actually increasing as well. So the variance of the distribution has been increasing and is projected to continue increasing. And from the perspective of sort of the first fact, what we can expect is that there are a few cold extremes, more hot extremes, but the second fact actually pushes in the opposite direction for cold extremes, more cold, and actually amplifies what we would expect to see on the right tail in terms of heat waves. And when you put these two things together, the IPCC actually says that with respect to extreme heat waves, it's, using their very sort of strongest language, they say it's virtually certain that heat waves are going to become more prevalent. So we can expect to see relatively long, very hot, and more frequent heat waves in the future. And so given this evidence, the three of us got together and said, look, there's all this scientific evidence. These IPCC reports come out and tell us so much about what we know and what we can expect to see with respect to climate change. But from a financial economist standpoint, there was really little known about what effects, if any, these climate risks, and in the case of this paper, extreme temperatures, might have on corporate profitability in the U.S. And so the aim of the paper is pretty simple. We really want to just try to characterize how extreme temperatures affect companies' earnings in the U.S. We're going to take the approach of trying to characterize this at the industry level. And we think this is an interesting question, not just from an academic perspective, but of course from a policymaker's perspective, trying to think about where the potential effects of climate change in the future might live, and what types of policies one might want to adopt in order to deal with those effects, but also from, let's say, an investor's perspective or an analyst's perspective who's interested in thinking about financial markets and the impact that extreme temperatures might have on different firms given their geographic footprints. So hopefully this is something that will appeal to a wide group of people in the audience. In terms of prior literature, potential channels, Michael did a great job sort of listing the papers in this burgeoning literature, and I definitely have a very incomplete list of papers here in terms of what's gone on in the past. What I will say here, rather than going through these, I'll say that there's good reason, first of all, to think that extreme temperatures might have an effect on profitability, in that we have a few channels in mind that are sort of motivated by existing literature. One is the literature that my co-author Ariel works in, again, sort of looking at agricultural outcomes. So there's a literature that shows that extreme temperatures actually do negatively impact crop yields, farm operating profits. So there's definitely an agricultural angle here that might flow through the economy and into certain industries. But it's not limited to agriculture by any means, at least in our view. We think that we might see effects that show up because of labor productivity drops. So for example, outdoor construction, things like that might drop when you see extremes sort of one end or the other. And then you might think of this from the perspective even of sort of retail or office work, where the work is conducted indoors in a temperature controlled environment, but where the cost of keeping the indoor temperatures constant fluctuates with the extreme temperatures outdoors. So when it's really hot outside, it costs a lot more for me to keep the temperature sort of comfortable for my workers so that they can maintain productivity indoors. Now, sort of zooming into the literature on climate change and the impact on financial markets, there's sort of a burgeoning literature here. I've listed a partial list here of work. One paper I'll point out, of course, is our moderator, Nora, has a paper with Rob Bauer and Jawad, where she shows actually among European and Asian firms, I believe, that extreme temperatures actually do hurt revenue and operating income. My co-authors and I have a paper in the March issue of the Review of Financial Studies, where we do something a little bit different from what we do in this paper. There we try to come up with sort of a population average effect for establishments in the US. And the basic idea is, do extreme temperatures affect productivity, sales growth for the average sort of US establishment? And we don't really look at heterogeneity, variation in the cross section. The answer in that paper is that we really find sort of a set of precisely estimated null results. We don't find much going on for your average sort of retail establishment or manufacturing establishment. And I think a lot of what's going on in terms of what happens at null result is that we're masking a lot of variation. And that's exactly what we're going to do in this paper. So the paper here is one where we want to think about variation in the cross section. And the way we're going to look at this is to sort of try to characterize the extremes at the industry level in the United States. Now, how we're going to do this, what we want to do is build a panel of U.S. public firms' temperature exposures. And so we want to, for a given operating quarter, come up with an idea of how much time did that company's establishments, so given their geographic footprint, how much time on average did they spend across different temperature buckets ranging from -15 to 50 degrees Celsius. And so we want to take into account the fact that, of course, weather's location specific, and we want to take into account firms' geographic footprints. So we're going to put together two sources of data that are going to allow us to do that, I think, with a high degree of confidence. One is that we've got this really cool data from the PRISM Climate Group at, I believe it's Oregon State University. This is the USDA's official climatological database. And what this tells us is across just over 480,000 4x4 kilometer grids, so 16 kilometer square grids that cover the continental US, it tells us the time spent each day in each of, I guess it's 66 1 degree Celsius temperature bins, ranging from -15 to 50 degrees Celsius. And then we can match that up with firms' geographic footprints that we get from the NETS establishment time series. And so this is establishment level data that actually tells us the addresses of public firms' economic establishments. And so for a given public firm, we can tell over time what their geographic footprint looks like, where their plants are, map them directly to one of these 4x4 kilometer grids, and then we can come up with what was the temperature exposure at those different locations, and sort of add that up using a sales weighted average to come up with a firm level measure that we can then relate to profitability. Okay, so that's the basic approach here. To give you a better taste of sort of the data that we're looking at, I've given you an idea of the PRISM weather. So this is actually the weather grids that cover Tompkins County, New York. So I'm sort of sitting right in the middle of this at the southern tip of Cayuga Lake right now, speaking to you. And this is for anybody who's come to Cornell University or Ithaca in New York, you'll know that this is for the most part a pretty rural county. It's a relatively small county. You can drive sort of north, south, east, west, 30 minutes, any time of day, any day of week. And what we have here is like 107, 108 of these grid points that cover different locations. And there is variation because we also have, gorges and hills and mountains and things like this here. And so there is actually variation across, within a county, but across these different grids. So it's important to be able to pinpoint exact locations and temperature exposures at these different locations. And then in terms of what we match that up with, we've matched this is a map of the NETS establishment level locations. So this is about 170,000 locations that we were able to match to publicly traded firms. And you can see sort of the usual suspects show up geographically in terms of urban areas, but we actually have representation across all of the continental United States in terms of establishments. And so we're going to map these those weather data to these establishments and then roll it up to a firm level measure for each fiscal quarter that we can measure profitability. Okay. Again, in terms of giving you an idea of sort of exposure to temperatures, the exposure measures that we have, this is a map of across all of those 4x4 kilometer grids in the U.S. These are temperatures above 30 degrees Celsius in July 99. So again, you can see lots of variation, and this is something that varies in the cross section of the time series as well. And so the main questions of the paper, the first question again, and again, the sort of big question that motivates, the whole paper is, do temperature shocks affect firm profitability in the U.S.? And the basic answer that we come to in the paper is that, contrary to what we've found in the past when we're looking at a population average that, can mask variation and interesting variation, we actually find that the predictive effects are important for a relatively wide set of industries. We look at this for 59 different industries across different calendar quarters, and we find that out of those 59 industries, 24, just over 40%, actually exhibit some sensitivity in terms of their profitability to extreme temperature exposures at some point during the year. And then we spent some time looking at mechanisms that drive the predictive effects. Again, in terms of sort of relating to the motivation and the past literature, we seem to find some effects associated with electric use, things that are consistent with labor productivity stories. So again, the story about construction and outdoor work that becomes much more difficult when individuals are trying to be productive and work outdoors in extreme heat, for example. We don't find a lot in terms of the agricultural channel. The agricultural channel is one that, at least in the United States, is large agricultural firms like Cargill tend to be privately held, and so they don't really show up in our database of publicly traded firms. So I think a lot of it has to do with that. But really, what we also seem to find is sort of evidence of intertemporal demand shifts, where basically, if we've got an unseasonably warm winter, people start engaging, for example, in spring-like activities, and similarly, if we've got unseasonable, lack of heat in the summertime, people start engaging in a different set of activities. And so we seem to find evidence of really demand driving a lot of this, and sort of revenues driving a lot of the profitability effects. Second half of the paper, I'll show you some evidence related to this today. The second half of the paper is devoted to analysts, and we've got some analysis on stock returns that I won't talk about today as well. But really, in terms of analysts, what we want to think about is, they really understand any of the stuff that we're documenting here. So we are sort of looking at the data and really trying to understand the data generating process. What is it that determines profitability at the industry level? Sell-side analysts who are trying to come up with earnings predictions, right, and set the expectations of the market. Do they seem to understand these relationships? If so, where or where not? And it turns out that they understand it for the majority. I think 7 out of the 24 industries that we identify, they don't really understand, and the rest they seem to. And then we really try to dig in a little bit more in terms of analysts' experiences and beliefs. So thinking about things like whether analysts have covered firms in the past that have gone through extreme temperature episodes, whether an analyst has a lot of experience or themselves is located where there's an extreme temperature episode. And then beliefs, thinking about things like political affiliations or, again, location and sort of beliefs, location-based beliefs about climate change. And we don't find much in terms of heterogeneity there. Okay, so that's the nutshell. I'll give you some of the sort of nitty-gritty at this point. You can see some of the results. What I can do in terms of the first question is, again, the approach here is going to be specify a process for earnings as a function of time spent in each temperature bucket. And then we're going to estimate this process for GIC's 6 industry subsamples by calendar quarter. So we're going to do this for 59 different industries, 4 different calendar quarters. We're going to actually estimate these processes for 236 industry quarter combinations. And I won't go into sort of the technical details here, but the basic idea is that we want to specify earnings at the quarterly level for a given industry J as a function of a bunch of control variables that we would typically include in these types of regressions, but also this in here that incorporates a G function, which is a function of H, which is heat. And you can think of that G function as basically mapping time spent at a particular temperature, H, to an effect, a marginal effect on profitability or on earnings of firms in a particular industry, J. And so this can be a relatively flat function that basically says, look, there's no relationship between time spent at different temperatures and profitability. It can be a linear function that has a positive or negative slope that says, look, there's sort of this linear relationship at extremes good, at other extremes is bad. Or it can be nonlinear, right? It can be U-shaped, inverse U-shaped, it can be S-shaped. And we want to give that sort of flexibility. So we actually adopt this methodology that comes from the agricultural climate literature to use Chebyshev polynomials, and we're going to be able to estimate this with a reasonably high degree of accuracy. And what it ends up giving us is, for example, for the construction and engineering industry, some neat sort of impact functions that, again, map on the x-axis different Celsius and time spent at those temperatures to marginal impacts on profitability. And a lot of times these things are really noisy. So, for example, for construction, Q1, Q2, and Q4, so corresponding to winter, spring, and fall, are going to really not give us anything. That we've got 95% confidence intervals in those shaded in gray. But what we do find is a very statistically and long impact of extreme heat in Q3 in summer. And so the idea here is that, the data actually tell us that if you have exposure to temperatures above 32 degrees Celsius, which translates roughly to 90 Fahrenheit, construction firms end up having a precipitous drop in profitability. And a way of thinking about economic impacts here is saying, hey, well, look, if we were to double that last 5% of the tail of the distribution, this would actually end up wiping out average profitability for firms in the construction industry. So we think that's economically pretty important right there. Another industry where we find something is electric utilities. So for example, Q1, again, wintertime, you can see that if you have abnormally warm temperatures, right, if you have temperatures that exceed about 18, 19 degrees Celsius at the locations where these electric utilities are operating and where their customers are, you end up seeing a drop in profitability. The magnitudes are very small, though, right? So there's a lot of hedging probably going on here among these firms. And you see exactly the opposite relationship if you look at Q3, summer temperatures. Abnormal heat, is going to lead to higher demand for air conditioning, and that's going to lead to a bump in profitability. Opposite case is going to be true for abnormal cold, where people are not going to be using air conditioning as much as they normally would, and that's going to lead to a drop in profitability relative to sort of the baseline that we would expect. And then the main table in the paper is really one that I've presented here, that we actually put down for different calendar quarters and extreme cold or heat shocks, which industries are sensitive, what direction the effect is on profitability, and what the critical temperature threshold is. The nice thing about the approach is that we don't have to specify what is an extreme temperature. The data will actually, tell us this in terms of what represents a critical temperature threshold for a different industry. And again, it turns out that these are bidirectional effects. So again, this is why we end up, when we look at the population level, getting something that averages out to zero. But it turns out that we're masking some really interesting and important variation here across industries. The second half of the paper, as I mentioned, really sort of focuses on analysts and thinking about whether they understand these relationships. And so we basically run the same types of regressions with the same sort of independent variables on the right-hand side and the same measures. But really what we're interested in here is saying, hey, is it the case that analysts are, in terms of their consensus forecasts, exhibiting a similar sensitivity to exposure to extreme temperatures? And then even if they do they actually fully capture this information in terms of eliminating earnings announcement surprises? Is it the case that, when you have extreme temperature exposure in a given quarter, that you can or cannot use it to predict earnings announcement surprises? And there's variation on that dimension across industries as well. So for construction engineering, for example, if you remember, we had 32 degrees Celsius in summer as being this critical temperature threshold. It turns out that if you look at the EPS forecast, analysts are not taking this into account at all. And subsequently, if you look in the bottom left quadrant there, in terms of standardized unexpected earnings or earnings announcement surprises, you can actually predict them by using sort of temperature extremes. Exactly the opposite for electric utilities. Analysts seem to get it, and you can't predict what's going on there. Okay, so with that, I'll conclude and just sort of leave up my concluding slide here, leaving some time for Q&A. Thanks.
Awesome. Thank you so much, Jawad. Again, I think the audience might still need a minute, so maybe we can build that in here. Yeah, and actually there was one more question coming up for Ivan. Jawad, if that's okay, if we can steal some of your time, should we quickly answer that?
Of course.
And
please.
then we'll get back to you. Okay, so the question was, I think it's a broad question about any data available on something closely related. So the question is from Austin Sauce from Caltrans. And Austin is asking, is there any data on lending to communities after natural disasters where people, potentially even where people are pushed toward relocation instead of rebuilding? Ivan, do you know anything about, so to say, these related data sets?
Okay, this is interesting. I mean, I've been looking for such data myself. I think data on lending to small firms is scarce, especially like in the States. So I think that's tough to find. But I know NOAA has some lending programs with SBA. So maybe that's where you can look at. I think you should see some of these loans that like. It's not FEMA, sorry. FEMA like makes to like individuals in like small firms in an area that's affected.
Great, thanks, Ivan. And now we have one for Jawad. So
Sure.
Jumping back to this talk, and the question is from Ruishi from Johns Hopkins University. Do you also consider the effect of a prolonged period of high temperature? So for example, a heat wave with a high temperature in 3 days in a row may be higher than a sum of 3 separate days. Yeah.
Right.
Jawad,
So we
thoughts?
are assuming some sort of separability there. We have not put that type of structure on the data, but I think that's a good point that 3 straight days are going to be different than 3 days separated by more temperate climate. So that's a very good point, and I think as a first pass here, we've just assumed like a time separability here.
Great, thank you. And maybe I'd have one last question. I would be really curious about your thoughts. So it goes a little bit beyond the project maybe. So in California, there's been a standard introduced on protecting workers from heat outdoors. However, both in California and on the federal level, I think there are also discussions about implementing a standard for protecting workers indoors. So I was wondering, since you study this industry heterogeneity really, really neatly, what are your thoughts on that? Do you feel like this problem or this effect is constrained to outdoor industries only, or could that be something that extends beyond it?
Yeah, I mean, in terms of sort of the effect of that type of regulation, obviously it's great for workers, but I think in terms of profitability effects that we document, I think the same thing is likely to happen in that productivity on really hot days essentially is going to drop. Maybe not endogenously as before. Now there's this exogenous thing that pushes profitability to zero. But I think it is going to hurt firms, and we're going to see maybe even an amplification of our effect. In terms of sort of effects on firms that have workers working indoors, I think it definitely can have an effect. I mean, one is through simple, again, sort of demand shifts. I mean, if it's extremely hot outside, where do I want to be in a post-COVID world? Hopefully, we are going to go into an air-conditioned mall, right? We're going to go somewhere and spend more time indoors and be more likely to sort of shop in those locations. And so I think, consumer choice is going to be an important thing here that drives a lot of these effects. And I think that's consistent with what we find.
Yeah. Yeah, again, that makes a lot of sense. Great. With that, I think it's time to wrap up. So thanks a lot, Jawad. That was really interesting. And let me again thank you all for joining the session. Also, thanks to the audience. Thanks for tuning in again. And I think we really hope that you stay with us for a little bit longer. So there's one more session, breakout slot number 4 with 4 different rooms. So it would be great to see you there. Yeah, thank you very much.